Whatever happened to the month of May, closing out the month with some big equity market gains on the Nasdaq. From the month for the session, we're down about 0.5%. A bit of a weakness, counting you down to the opening bell. The countdown starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
The debt limit deal was struck by the President and Speaker McCarthy heading for a vote in the House after clearing a key procedural hurdle. Investors now hoping we avoid any needless political drama, refocusing minds ahead of next month's central bank decision. Cleveland Fed President Loretta Mester pushing for another hike, telling the Financial Times, "I don't really see a compelling reason to pause. I would see more of a compelling case for bringing rates up." Bank of America's Mike Gapen calling it a close call. Even if the Fed skips June, it will keep July in play. He says the data so far supports further tightening. The Fed, of course, contends it is data dependent, whatever that means. The calendar for that data looks a little something like this over the next 2 weeks. And Citi's Andrew Hollenhorst is setting the bar for another move, saying, quote, 200,000 new jobs in data out this week. Another 0.4% month-on-month core CPI reading on June 13th would further cement a June hike. JP Morgan's Jamie Dimon saying they can go further.
You know, my simple view is that, you know, they're right to pause at this point. It's been a big increase, 500 basis points or so. Take a pause. But I do think it's possible they're going to have to raise a little bit more.
Let's get to the Bloomberg team. AMH down in Washington, D.C., alongside Katie Lyons. AMH, I said at the start, this is something Wall Street wants to forget. Do you think we can achieve that a little bit later?
Yeah, Wall Street certainly wants to forget it. To be honest, Jonathan, since the Treasury Secretary came out with her first letter about using extraordinary members since January, I think all of us want to forget and put the debt ceiling debate behind us. It does look like the path is clearing for this to move through the House. You're really going to want to pay attention to the numbers, though. Speaker McCarthy really wants to get a majority of his Republicans over the finish line on this. What we're hearing is about 150. A lot of this will also show with how strong his speakership is. And then, of course, it has to go to the Senate. Now, everyone thinks it will pass the Senate, but it doesn't mean it's going to be an easy process. You're potentially going to have a number of senators come up. They're going to want to make amendments. Lindsey Graham, we know, he is one that wants to see higher defense spending because he's worried about the impact of inflation. You have others like Mike Lee of Utah saying it's not enough cuts. But by and large, it looks like this is going to be able to get passed before, or at least signed by June 5th. When the Treasury Secretary says that's the hard deadline for the debt ceiling.
Katie, get through the House, then onto the Senate. Any problems that you foresee?
Well, as Anne-Marie was just suggesting, you could see any one senator hold things up, whether that be Senator Mike Lee or potentially Rand Paul, who wants to force a vote on his alternative plan. So the procedural hurdles are very large because it does require unanimous consent to actually accelerate the process, which does risk bumping up or maybe going over that June 5th deadline. So default isn't entirely off the table, even if we have the House passage today. Now, on that note, of course, if we saw a default happen, something that has never happened before, that very likely would change what the Fed does in 2 weeks' time. If we don't, though, and this deal goes through, what we hear from economists by and large is that it doesn't have a massive impact on the macroeconomic outlook. You may see at the lower end of the income spectrum because of the restart of student loan payments and some of the stricter work requirements for entitlements impact there. But overall, we're talking just a 0.1% knocked off of GDP in fiscal year 2024. So unlikely to really change the growth picture for the economy. And then, in theory, for the Fed. The one thing we do have to consider here, though, John, something we've talked about at length as we've gotten closer to the actual debt ceiling being raised, is the liquidity implications, the stresses that may cause in a banking system that already isn't the most stable at the moment.
It's a big question. Katie, thank you. Alongside Anne-Marie, ahead of that vote a little bit later down in Washington, D.C., going into the opening bell about 25 minutes away. Equity softer here, negative by 0.5%. Joining us is BlackRock's Jean Bavin. Morgan Stanley's Matthew Hornbeck joins us too. John, I want to start with you and go to that quote from Andrew Hollenhorst, the Citi, who says 200,000 on payrolls Friday. CPI, June 13th, month-over-month core 0.4. We get those two things. He says hike is on June 14th. Do you agree?
Well, I'll just start by saying it's pretty remarkable that the last meeting was about engineering this pause that was widely expected. You know, and I think we're seeing the playbook that we've seen in Canada and we've seen in Australia, which is like an attempt to pause, but quickly gets derailed with the need for further tightening, that becomes obvious. So I don't have a strong view. I think the most important thing is that they're not cutting anytime soon. That was the biggest disconnect. That disconnect is disappearing now. Much more important than whether they hike. But yeah, I think the odds of hiking now are reasonable.
President Mester has a strong view. I don't really see a compelling reason to pause. To the Financial Times. Matt Hornback, do you see a compelling reason to pause?
John, yeah, we do. Our chief U.S. economist, Ellen Zentner, does not think the Fed is going to deliver a hike in June or July for that matter. But yeah, I mean, I do think that there is a compelling reason to pause. And that reason has already been articulated by both the chair, Governor Jefferson, which is the idea that monetary policy operates with lags. This is something that is not always immediately obvious in the sense that you don't get this immediate transmission from a rate hike into the real economy in real time. It takes a period of months or quarters and sometimes more than a year. And so I do think that there is a very real reason for the Fed to pause here and see how the economy evolves.
Matt, they seem to hate that word, though, pause, because they seem to believe, and I think perhaps some of us agree, that it implies cut is just around the corner. Matt, how do you think they're going to manage that?
Well, I mean, they've already tried to better define the word pause by entering the word skip into our lexicon. I mean, like when I think about the word pause, I think about watching a movie and I push pause to go get some popcorn. I don't come back to the movie and then rewind it. You know, I just push play again. So I think the word pause is plenty descriptive. But yeah, the history of the Fed suggests that when they stop hiking for any length of time, the next move is a rate cut.
Jean, one key feature of your outlook for the whole of this year, you've pushed back against these cuts big time. And when it comes to the equity market and risk assets, you do not think the Fed's going to bail us out this time around. Is that, Jean, because you still believe that this inflation backdrop is going to be stickier for longer?
Yeah, I mean, you know, I think we're going to end up eventually getting close to target on inflation. Over, I mean, I don't have a strong view on when. I don't think it's going to be in 2023, and it won't probably be in 2024 either. But we're going to head towards that. But what is fundamentally different from what we've seen for the past 40 years, is that we're in a world where we're going to see ongoing inflation pressure underneath that will require essentially a tightening bias to be a structural tightening bias to be at play, which is the opposite of what we've been saying for the last 40 years, where there was like a structural easing bias. So I think that's the fundamental difference. And as a result, I think that the biggest part of the playbook, usual playbook that doesn't apply this time around, is that they won't come to the rescue easily if the economy tanks. The economy slowing, contracting is part of the recipe. And that's the part, yeah, we've been pushing pretty hard throughout the year. I think the market has moved now closer to what we think is in line with what's going to happen. But yeah, no rescue, I think, is the starting point.
Jean, tell me what that means for portfolio construction. And help me understand what that means for my allocation to fixed income. Now, you and I have talked about this a lot over the last few months. Fixed income, for now, for once, compared to the last 10 years, now offers me some income. What I'm trying to work out, and it's something that you've tried to answer, is whether it will offer me that inverse correlation to risk, that diversification within the portfolio. Have you got your doubts about that further out along the curve?
Yeah, so just to start on the income piece, right? So I think the fact that we don't see a rate cuts or an easing cycle coming, I think bolstered this case of income is real. Short duration fixed income is very attractive, continues to be. I think we're going to be able to clip some of these income for the foreseeable future. Now, the Fed not coming to the rescue, to our mind, has been the key catalyst for how bonds and duration has played a ballast role it has played since 2000. It was because of this Fed central banks coming to the rescue whenever needed, taking the downside, which in our view is, as I said, is not happening. And that calls into question how much faith you should have in duration and long-term bonds playing their ballast role. So we're skeptical. We think there still is a pretty entrenched playbook in people's mind, markets participant, and when they hear recession, there's a bit of movement in yields lower. So I think that can play as a trading kind of tactics or a very short horizon kind of tactics that can continue to play. But in terms of portfolio construction, longer term, I think the ballast properties have been weakened in this environment considerably.
Matt, do you share that skepticism?
I guess I'm less sure, John, myself. I don't think we've had a long enough bout of high inflation to say that the next 20 years we're going to see inflation persistently above target, and therefore the Fed is going to have to act with a bit more caution in terms of their reaction function. I just don't think we've seen enough data to clearly say that at this point. So I would say I'm reserving judgment on that one at this point.
Bob Michael at JP Morgan Asset Management out this morning looking for 3% right across the curve through this summer, looking for cuts in September. That's pretty bullish on treasuries. The 10-year right now, 360-ish. The 2-year at the moment, 440. We'll keep building on this. Jean Bavin, Matt Hornback are going to stick with us, luckily, fortunately. Going into the open in about 20 minutes away or so. Equities near session lows, negative 0.5%, with some movers going into the open. Here's Abby.
Hey, John. Well, we are looking at the S&P 500 heading toward its first down day in 4 sessions, potentially. So we're looking at lots of laggards. First, though, let's take a look at American Airlines, up nearly 3%. This after the airline did boost their second quarter EPS outlook, their capacity. They held that view. One measure of revenue is a little better on strong demand. To the downside, though, NVIDIA, after its best 3-day rally since 2002, up more than 30% over that time period on that monster outlook raise, down today, down 1.7%. But clearly the big plunger here, John, Advanced Auto Parts heading to a possibly record decline, down 29.4%. They cut their full year profit view by about 40%. They slashed their dividend by 80%. It's going to be interesting as the day progresses to find out more of what's behind that big revision, frankly.
Abby, thank you. Coming up on this program, Jamie Dimon at JP Morgan weighing in on China.
China's obviously going to do what they think is good for itself, and business might be a positive attribute. But national security will trump all other issues.
The latest data disappointing once again. That conversation up next.
If you have more uncertainty, some of it caused by the Chinese government, well, of course, it's going to not just change foreign direct investment, which has gone up a little surprisingly, and I don't think they should assume that's going to continue, but it's going to change the people here, their own confidence, their own ability to invest and do things. China's obviously going to do what they think is good for itself, and business might be a positive attribute, but national security will trump all other issues.
Jamie Dimon at JP Morgan speaking exclusively with Bloomberg on China and other issues as well. This was a consensus call for the year ahead. It was get overweight all things connected to this story in China, the reopening, better economic growth, and then this happened. PMIs overnight, manufacturing 48.8, the estimate 49.5. Services holding in, but manufacturing disappointing. And as this dropped at about 9:30 Eastern time yesterday, this dropped too. The euro dollar breaking down to about 106.85 on the screen right now, negative by 0.5%. And some measures, some Chinese indexes, equity markets, showing the equity market in China in a bear market. Mike McKee, that's not the way this year was meant to go.
It is not the way this year was meant to go, and there's a lot of things going on. Jamie Dimon maybe underscored it when he talked about uncertainty, because there is the international diplomatic effort by the United States to sort of isolate China technologically, and there is also the Chinese effort to clamp down on its own economy and to become more centrally planned. And you can see what's happened, John was just talking about, with those PMIs, especially manufacturing, falling far short. Now, the hope was that a lot of people would spend money coming out of the pandemic in China, and we did see an initial pop in services, but those have rolled over as well. And overall, what you're seeing is a decline in what they think is going to happen. The country put out a very conservative 5% growth rate. Economists still think they're going to get 5.5 for 2023, but the 2021 GDP came up 8.4%. And in the years before the pandemic, they were regularly in the high sixes. So China definitely slowing down. That's having an impact on the world now. We are seeing demand fall for imports into China, particularly for commodities, which could have a big impact in the United States and Europe in terms of inflation. You can see there what's happening with the metals for copper and for iron ore breaking down through some key levels as Chinese demand drops. And so we are looking, John, at a situation that is going to have different impacts on the global economy, maybe bring down inflation, but also maybe bring down growth a little bit.
Mike McKee, thank you, sir. Pleased you brought up commodities, 68 on WTI. Thank you, Mike. We're down by about 1.6% this morning. Brent crude in the low 70s at 72. We're negative 1.4% there. Jean Bavin, Matt Hornback back with us. Matt, this wasn't the way this story was meant to go this year. We had the reopening of China. Global growth was meant to get a boost. What do you make of the incoming information so far, Matt?
Well, John, it certainly hasn't been supportive of these consensus views. I mean, our economists have also been quite bullish on China, vocally so. But, I think ultimately what they're counting on at this point is policymakers in China to take a more serious approach towards easing conditions to encourage growth to rebound as we make our way through the second half of the year. So that remains the view, but certainly the data have been surprising to the downside.
And Matt, this market's just been beating up consensus views coming into 2023. Don't touch tech, it's ugly. Had a bad year last year and then tech ripped. Similar story with the US dollar. The US dollar gets short, the rest of the world's looking better. Then the last month or so happened. Matt, where are you and the team now in the US dollar?
John, well, so we came into the year not liking the U.S. dollar, in part based on the idea that China's economic recovery would be real. But, what we did a couple months back is we pivoted to a long dollar stance, and we maintain that today, John. Positioning at the initiation of our long dollar view was very bearish, the U.S. dollar. That positioning has changed a bit over the course of the past month or so, but we remain convicted that the U.S. dollar has further to run higher, and certainly China disappointing has been helpful to that view.
What am I going to see first, Sean? 110 on euro dollar or back to parity again?
I think good question. I don't have a strong view on the direction of the euro dollar. I think maybe there's a bit more weakness that can come through. But to your point on the China story, I'm just back from 2 weeks touring the region, and I think we used to say that the farther away you are from China, the more bearish you are. And I think one thing that is unusual this time is I think it's the opposite. The closer you are, the more bearish you are. I think there's an animal spirit kind of issue really playing out. This is the wobbling we've seen over the last couple of weeks in the data, and that's the risk aversion from a Chinese consumer is very material. So we are still constructive on China and the region because of the very different backdrop in terms of policy that you can see there. So there's an ability to respond. They're reluctant to deploy it, but there's the possibility to do it. So there's a floor. But yeah, I think that broad thesis is more questioned over the last 2 weeks than you would have expected at the beginning of the year, as you said.
The outperformance in the US tech on the equity market versus China tech has been phenomenal. I was looking at the numbers this morning. The Nasdaq Golden Dragon Index is down 10% year to date, well off the highs, deep into a bear market. The Nasdaq 100 is up 31% over the same time period. I've been having this conversation repeatedly about US equity market exceptionalism maybe making a comeback, Sean. Where are you and the team on that at the moment?
Yeah, I think the tech story. I mean, it's a different tech story from last year, right? So you said these consensus have been shattered this year. This consensus beyond tech being not the place to be. I don't think that's the same tech story we've seen last year. It's a big AI, really exuberant story happening. I think there's something real there. It's very difficult, though, to know who's going to be the winners of that. So I think the thematic is pretty real, how it's going to play out, who's going to win, who's going to lose. And very difficult to see such a massive story, if you believe it, which is behind the rally we've seen. If you really believe that, very difficult to believe that, and at the same time not expect massive losers from that, which hasn't been reflected yet either. So I think these thematics are real. We believe them, but I think a bit less clear about exactly where to play it out, and not convinced that the current players will necessarily be the sole winner. So something to get exposure to, but think hard about the valuations.
You're not alone. Jean Bavin there, alongside Matt Hornback. To the two of you, thank you. That's the moment we're in right now. Are we on the edge, the brink of a melt up or a meltdown? We've had that conversation a million times. Look at the equal weight S&P 500. Strip out the muscle of big tech. Month to date, we're down on the month by 3% on the equal weight S&P. Month to date on the NASDAQ, up more than 8%. We're talking about 11 points of outperformance on the NASDAQ 100, driven by some big names like Nvidia, Meta, and it's not just those names. AMD, Salesforce, Tesla having monster years so far after difficult times through much of last year for some of those names. Going into the opening bow to close out the month of May, we're down by 0.4%. Coming up next, the morning calls, and later, Bank of America's Jill Carey-Hall joining us at the opening bow, weighing in on weakening breadth concerns. That conversation still ahead. 5 minutes away from the opening bow, softer here, negative by 0.5% on the S&P 500. Likewise on the NASDAQ, down about 0.5% or so. That's the price action. Let's get to some morning calls. JP Morgan upgrading Chevron to neutral. 170 price target, saying the company is well positioned for a potential downturn. We're down 1% there. Deutsche Bank upgrading Ava's budget to buy, pointing to the stock's attractive valuation and overly negative sentiment. That stock is up by more than 4%. And finally, Credit Suisse raising its Microsoft price target to a street high 420, highlighting the company's rapid growth in AI-related products. There's another one. Microsoft 331, almost 332 in early trading, positive there by a little more than 0.1%. Coming up, stocks closing out another monthly advance despite the weakest breadth on records going back to 1990. That conversation up next with Bank of America's Jill Carey-Hall. 24 seconds away from the opening bow this morning. Good morning to you. Negative by 0.5% on the S&P 500. On the NASDAQ, down by a similar amount. No real drama here going into the opening bow as we close out the month of May and a stellar month of gains for the big cap names in big tech. There's your opening bow. Switch at the board and get to the bond market. Yields look like this on a 10-year, down a single basis point, 367.32. More Fed speak from Loretta Mester in the Financial Times, signaling she wants to hike again in the month of June. Others will follow. Let's see what the Fed speak looks like going into the quiet period, which kicks off on Saturday. Bit of dollar strength out there, euro weakness. That euro weakness pronounced. Much more so following that economic data out of China, disappointing. The euro 106.86. Haven't seen 108 for about a week. Euro dollar negative by 0.5%, and crude breaking lower. We're talking about multi-year lows now potentially on WTI in the 60s, 68 on WTI, down about 0.8% this morning. One stock to watch at the open, HP, shares under pressure after reporting lower than expected 2Q revenue. The CEO saying this: the macro situation is obviously impacting demand across industries. However, we think the second half will be stronger than the first. Abby has more. Hey, Abby.
Hey, John. It's interesting because analysts seem to agree with the CEO of HP that the second half demand will recover. But in terms of the second quarter, it was disappointing. Sales came in light of what was expected. They declined 22% to $12.9 billion. The personal system segment fell 29% to $8.2 billion. That was short of the average analyst estimate of $8.4 billion. On the year, John, we do have analysts, though, echoing, again, what the CEO said, that the second half could see some sort of return to normalcy for PC demand. Morgan Stanley saying that this is the bottom. Lots of mixed messages here. On the year, this stock up about 15% right now, having its worst day since it actually might be a little bit more. I can kind of look while we're on air here. But when I last looked, the worst day since February of this year. And I think it's going to be a greater decline, which suggests that traders are weighing these results despite the fact that there could be some kind of recovery. Yes, we're looking at the worst day say since August of last year, that traders are really weighing these results and not paying as much attention to the possibility of that second half recovery. We'll have to stay tuned.
Down 6%, Abby. The hope things get better. That's always the hope. Right now on the S&P 500, negative by 0.3%. NASDAQ just a touch lighter. We're down there by 0.2%. Want to stick with earnings. Shares of Advanced Auto Parts getting hammered after missing on Q1 estimates, cutting its full-year guidance and reducing its quarterly dividend. The CEO writing, quote, "We expect the competitive dynamics we faced in the first quarter to continue, resulting in a shortfall to our 2023 expectations." Katie Greifeld has more. Hey, Katie.
Hey, John. Well, as analysts from Truist phrased it, everything that could go wrong, whatever could go wrong, did go wrong when it comes to this report. Nearly every metric was disappointing, John. Like you said, the auto parts retailer cut its earnings and sales guidance for the full year. It did reduce that quarterly dividend from $1.50 to just 25 cents. And that's all after, of course, it missed estimates for the first quarter. Like you said, CEO Tom Greco saying that the competitive dynamics that we saw in the first quarter will continue to hound Advanced Auto for the year to come. To get a little bit more specific, the company now sees full year EPS between $6 to $6.50. The previous forecast was between $10.20 to $11.20. So a big cut there. And as you would expect, the market reaction has been swift and it's been brutal. Right now, shares are off by almost 29%. As such, right now, that is the worst day ever for Advanced Auto.
Wow. Katie, thank you. A third of the market cap gone. Just like that. Let's stick with the auto sector. Tesla's Elon Musk meeting more government officials on the second day of his trip to China. Wedbush's Dan Ives saying the visit comes at a key time, writing this: "Playing nice in the sandbox in Beijing is something the street is laser focused on to make sure there's no disruptions to Tesla's expansion." David Welch of Bloomberg joins us right now. David, are we playing nice?
Really, Elon has to play nice in China. He's got an expansion going on, big plant in Shanghai. And he sells a lot of cars there. I think if you look at it, really, Mary Barra at General Motors has to do the same thing. So do the German car makers. They all have a big presence there. They have joint venture partners. And if you really want to grow your electric vehicle business and you want to get global scale for battery, electric motors, all that expensive stuff, you need to be able to participate in China. And the domestic players there are coming on strong, and BYD now being the #1 seller of electric vehicles in the world. So if politics cuts Tesla, General Motors, German car makers out of that market in any way, or even just diminishes their ability to sell vehicles there, that's a big problem for all of them in terms of global competition.
And David, this stock's had quite a year, up 61%. What's behind the monster gains this year relative to the difficulties we had in the previous year?
I think investors are getting used to the idea that Tesla's been cutting its prices. There seems to be a bit of stability there. I think they see Tesla having an ability to use their margin advantage to really hold off competition from the other car companies. I think last year, one of the things that hurt the shares was the fact that we had new EVs coming on from Hyundai, Kia, General Motors, Ford. And if Tesla can use a pricing advantage to still make decent profits while maintaining market share or even growing it, investors are going to like that.
David, the stock is a little bit lower this morning, down by 1%, but much, much higher on the year. David Welch there, thank you. From Tesla to Twitter, you might have seen this story yesterday that according to Fidelity, Twitter is now worth just 1/3 of the $44 billion that Elon Musk paid for the social media platform. But I think what a lot of people missed is this. Despite those issues, and because of the gains in Tesla, Elon Musk's wealth is up more than $48 billion this year. So never mind the $44 billion he paid for it last year. His wealth this year is up something like $50 billion US. Tesla is up 61% year to date, down about 1% on the session. Let's go from that to the financials. Goldman considering another wave of layoffs in what would be its third round of cuts in under a year. A representative for Goldman declined to comment. Kelly Lyons has more. Hey, Kaylee.
Yeah, John, when this news first crossed yesterday, we didn't see too much of a share price reaction. It ended the day lower by just a few tenths of 1%, but the losses are steeper this morning with the stock now down about 1 3/4%. So one of the laggards in the financial index on this Wednesday. Now, as you said, this would be the third round of cuts in less than a year. Of course, they eliminated several hundred jobs back in September of 2022. Then in January began their biggest round of layoffs ever, eliminating 3,200 positions. And now another round, we understand, according to people familiar, though it should be smaller, affecting less than 250 people. but they are expected to be more senior members of the firm. Of course, all of this happening as Goldman and banks across Wall Street are contending with a slump in deal making. That recovery has been very hard to find. It is a slump that likely will continue throughout the remainder of this year, and it has led to a reevaluation of costs. Goldman, if you recall, back in February said it does plan to reduce expenses by $1 billion, and potentially now more layoffs are going to be part of that story. Again, John, the stock down about 1.7% here in the first few minutes of trading.
Kelly, thank you. About 7 minutes into this session, more broadly on the S&P 500, we pulled back just a touch, down by 0.5%. Some relative outperformance in the Nasdaq, but still lower by 0.3%. Stocks closing in on another monthly advance thanks to the rally in big tech. The S&P 500 eyeing a third month of gains despite only 28% of the index trading higher this month. That's the worst breadth for a monthly gain on records going back to 1990. Morgan Stanley's Andrew Sliman weighing in on those bad breath concerns.
There's no conclusive proof that actually bad breath doesn't lead to always a sell-off. Many times it leads to broadening breadth in the market rally. I think that will happen. I'm just not sure, other than short term on a debt deal, I'm not sure that will happen until we get past Labor Day.
And joining us now is Bank of America's Jill Carey-Hall. Jill, wonderful to catch up with you. It's a conversation I've had with your colleagues, Savita, others too. I'd love your input on this subject too. Does narrow breadth matter?
Thanks for having me. You know, we've found similar to what was just mentioned in that, you know, narrow breadth and bad breadth in the market doesn't necessarily mean, you know, negative returns. You know, the better market returns have often followed periods of bad breadth. So we haven't necessarily seen that as a signal. That said, you know, the market has been led by a lot of these big mega cap tech or growth stocks. And, you know, we have a relatively benign outlook on the S&P 500 for the remainder of the year. We did get incrementally more bullish. We raised our target recently to 4,300 from 4,000. But, you know, we're more bullish on some of the areas like energy and what we'd call the old economy cyclicals rather than some of the newer growth areas. You know, we saw a sort of surprise bout of QE in the first part of the year, and that's an environment when growth stocks usually do well. But we expect more quantitative tightening rather than quantitative easing going forward. And, you know, we're equal weight tech. We would prefer tech to communication services. I think a lot of the AI spending and broader CapEx spending will benefit tech more, and it's a less crowded area. But there's still risks to tech as a cyclical sector, and you saw a lot of, you know, demand pull forward. So we're market weight the tech sector and would see leadership from some of the other cyclical areas.
Jill, let's deal with the index. As you know, year to date and month to date, we've seen massive outperformance for things like the Nasdaq versus the equal weight. The equal weight S&P 500 this month, and we've talked about this repeatedly this morning, is down by 3%. The Nasdaq is flying by more than 8%. That's 11 points of outperformance. This is kind of like historic stuff here, Jill. And if you don't have the muscle of big tech in a portfolio right now, the AI themes that you touched on, you're really not having a great year. Jill, why is this the time? And just to go back to your research, why is this the time to prefer the equal-weighted S&P 500 to the cap-weighted index?
Well, I think the equal-weighted index is, you know, much more attractively valued at this point, given the divergence that we've seen. A lot of the, you know, the cap-weighted index is much more expensive. It's, you know, more crowded in some of those areas. So, you know, better value. And you know, we do think, as I mentioned, that, you know, some of the new leadership in the market could be areas like energy, like parts of materials. You know, we could see a resilient CapEx cycle. You know, this year, even amidst a recession. So I think, you know, these are areas that could be the new leadership. The market has been hit by, you know, obviously everything going on with credit and the regional banks. Small caps have underperformed. The equal weighted index has underperformed given the rally in tech that we've seen. But at this point, we would prefer the equal weighted over the cap weighted index.
You head up the strategy for small caps as well over at BofA, Jill, so perhaps we can finish there. You turned cautious back in March, I remember, off the back of some of the financial difficulties. Given the weightings towards financials in the Russell, makes perfect sense. Jill, where are you in the team now on that particular topic?
Yeah, we've still been tactically cautious on small caps. We've obviously been watching the credit backdrop and the regional banking backdrop. The small caps do obviously have more exposure to regional banks as well as to credit conditions. We have seen further tightening, obviously nothing too detrimental. Our credit stress indicators that our firm tracks are still elevated, but we're not critical. So we're watching all of these. I also think, ahead of the debt ceilings, as we've seen market volatility, small caps tend to be more negatively sensitive to volatile markets. So, near term, we have stayed cautious, but I think if we can see, a stabilization in continued stabilization in banks and credit, and we just get this sort of mild economic recession that our economists are looking for, then, I do think small caps are pricing in the mild economic recession more adequately. And, if you have a longer time horizon, this could be a good entry point for small caps. We've still been bullish over the long term on small caps, relative valuations versus larger near decade lows. And, they're going to benefit from a lot of the multi-year themes like globalization peaking, reshoring. They're bigger beneficiaries of CapEx spending. They're more domestic. So I do think for a longer time horizon, we would see better return potential there.
Hey, Jill, always appreciate your input. Jill Carey-Hill there of Bank of America. They lifted their price target recently over at B of A to 4,300, incremental, as Jill said herself. Marginal upside there on the index, on the S&P 500. The enthusiasm over at B of A on the equal weight S&P, stripping out the muscle of some of the big gainers this year, which have been the likes of Nvidia and Meta. But that's where the gains have been. Is that where the gains will be in the second half of this year as well? About 13 minutes into the session, we pulled back by 0.3% on the S&P. On the Nasdaq, we're almost unchanged on the session. Coming up, the Fed in focus as more U.S. economic data hits the wires.
My simple view is that, they're right to pause at this point. It's been a big increase, 500 basis points or so. Take a pause. But I do think it's possible they're going to have to raise a little bit more.
It's the final 2-week stretch going into the Fed's June 14th rate decision.
My simple view is that, they're right to pause at this point. It's been a big increase, 500 basis points or so. Take a pause. But I do think it's possible they're going to have to raise a little bit more.
Sometimes economic data is so bad, it's good for treasuries. Yield to lower at the front end by 7 basis points on a 2-year. Mike McKee has the why. Hey, Mike.
Well, John, it's the Chicago PMI, which comes in very, very weak at 40.4, down from 48.6. The forecast was for just a small change. So that is considered bad news, but it is a tertiary indicator, and we have had some discrepancies among the regional PMIs. The real question is, what happens on a national basis? And because of the calendar, we got a very compressed week. Almost everything happening tomorrow and Friday. JOLTS comes out today, top of the hour. You'll want to stay tuned for that. That could have an impact on the market if job openings stay high. But then ISM tomorrow, we have a forecast for a very small change, but that could go down after we saw what happened with Chicago. And we'll want to see what happens in the employment index as far as ISM, but also ADP tomorrow and initial claims tomorrow. And they're all supposed to show some changes in the markets, but initial claims, we don't know the way it's been going. We do have, because of the shortened week, not much time for people to change their forecasts for payrolls. But Friday, John, we're expecting 195. We've been over the expectation for something like 8 months now. And unemployment rate, 3.5%. That would only be a tick up. And it would probably turn the conversation and the markets back to higher rates.
And Mike McKee, 3.5% unemployment does not scream recession. The data in services right now does not scream recession. But then you've got manufacturing, Mike. What is happening with manufacturing versus everything else?
Well, that's an interesting question, because usually if manufacturing is slumping, it's because people don't want to buy stuff. And maybe it's partly because they don't want to buy stuff because they're spending all their money on services, but it's a little hard to square the two things. And we won't get the ISM services number until next week, unfortunately, so we won't have that as an ingredient into jobs. But jobs and then CPI, those are going to be the big numbers that will set the Fed's course.
June 2nd, Friday, payrolls. June 13th, CPI. Mike, thank you, sir. From the data to the Fed speak, a host of Fed officials on the calendar throughout today, going into the quiet period this weekend, getting their final word in before that begins, and ahead of that June 14th rate decision. Ed Harrison joins us now. Ed, let's talk about it. Mester's talking about another hike maybe in June. Just how splintered is this committee becoming?
Yeah, I think we're at the maximum point of splintering, because you hear people like Chicago Fed President Austin Goolsbee, who wants to pause immediately. And then you hear others like Jim Bullard from St. Louis who are saying, look, we can continue going. Even Mester herself said that she would probably go for a hike. I think that Powell, he's able to get everyone on side. And I think the easiest way to get everyone on side at this particular juncture is to potentially pause as soon as possible, maybe as soon as June, and then to hold for a longer period of time. And they look like they're moving the market in that direction.
What kind of data points do you think we need to see between now and then for that to happen? Andrew Hollenhorst, the City, Ed, I think set the bar pretty low. He said 200K payrolls, 0.4% on core CPI month on month, and he said they're going to go again in June. How low or how high do you think the bar is right now?
Yeah, I think that the biggest thing probably is the labor market, as you were pointing out, payrolls. We're going to get the JOLTS data. That's going to tell us, whether or not the demand for labor is coming down. And then we're going to get as well the payrolls data. If it's over 200K, let's say 250, I think that's a really high number. We're already at about 60% chance of a 25 basis point rate hike on markets. I think you'd start to get closer to 80% at that juncture, and then the Fed would go ahead and probably hike again in June.
And maybe we'll get some dissent along the way for once. Ed, great to catch up with you, buddy. Let's catch up before we get that Fed decision. 2 weeks today, looking ahead to JOLTS. Ed talked about it. Mike talked about it. Alex Steele is going to break that down for you on Bloomberg TV in about 8 minutes' time. Your estimates at the moment, the previous number close to 9.6 million. Looking forward to that to come down to about 9.4 based on our estimates. That's the median estimate in our survey so far. So looking for that to come from 9.6 down to 9.4. You'll get the actual figure in about 7 or 8 minutes. Let's get you some sector price action. We can do that now with Abby.
We're looking at pretty bearish sector composition, John. Most sectors are lower, and we in fact have 4 sectors that are down. At the same time, we have 3 sectors that are up slightly: tech, real estate, utilities. To the downside, though, we're being led by energy, financials, materials, and industrials. Let's take a closer look at energy, because we, of course, as you've been talking about, have oil below $70 a barrel. Those China PPIs not so great, and actually that Chicago information not great either. But near year-to-date lows, down 13% on the year, John. Right now headed to its worst year since the pandemic year. Let's see whether or not those are recouped, or if oil and copper are sending signals about the economy.
Abby, thank you. Right now down by 0.4% on the broader S&P 500. Saw this market turn off the back of that Chicago PMI data, more specifically in a more pronounced way into the bond market at the very front of the yield curve on a 2-year. Now down by 7 basis points, just pulling back and retracing some of that move higher we've seen over the previous 11, 12 days. Last week, the week before that, the 2-year up big time. Month to date before today, the 2-year was up something like 44 basis points. So just chipping away at that as we go into June. We're down another 7 to about 437. Up next, your trading diary. 26 minutes in, stocks lower. Let's get to the trading diary. Coming up very, very shortly in about 5 minutes' time, we'll get you some economic data at the top of the hour. We'll get you the JOLTS report. Fed speak picks up this afternoon with Collins, Harker and Jefferson. ISM manufacturing numbers and another round of claims coming up on Thursday. Plus earnings from Macy's. That's still to come. But on Friday, it's the main event, the May payrolls report. looking back and looking for a number that could come in close to about 200K. The estimate so far, about 195. From New York, that does it for me. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.